All right, welcome to the Explainer. Today, we are tackling the Trump effect. It's this phenomenon that's completely rewritten the rules for how the market works. So we're going to explore how you can not just survive, but maybe even find some opportunities in this wild, new, unpredictable era.
You know, this quote here really just nails it. Love him or hate him, it says it all, right? It perfectly captures the biggest challenge for any investor today. I mean, we're in this totally new world where it's not just about earnings reports or what the Fed does anymore. Now you've got this new kind of headline risk that can just come out of nowhere and change everything in an instant.
Okay, so here's how we're going to break this all down. First, we'll look at the tweet-fueled market. Then, the new tariff playbook. We'll talk about why safe havens might be failing. Then, we'll get into a practical trader's survival guide. And finally, we'll zoom out and see what the future might hold. Basically, we're going to go from the problem to a real solution.
All right, let's jump right in. Section 1, the tweet-fueled market. I mean, we're talking about how just 280 characters can move billions of dollars. It's kind of wild when you think about it.
So just how big of an influence are we talking about? Well, get this. Researchers at IG went through over 8,000 tweets from his first presidency. And they weren't just reading them. They were measuring the direct, quantifiable impact on everything. Stocks, currencies, commodities, you name it.
And the finding was just crystal clear. A single tweet could set off these huge price swings across the board. But what's really crazy is the speed. We're talking about a 30-minute window. 30 minutes of just intense, chaotic volatility, all from one tweet. You can just imagine the trading floors going nuts, everyone scrambling to react. Okay, but it's not just about tweets anymore. That was kind of just the beginning. The whole strategy has evolved, moving from social media posts into actual official policy. And that, of course, has some major implications for global trade.
So check this out. According to analysis from Access Direct, there's a new tariff structure on the table. It starts with a 10% baseline tax on, well, all imports. But then it gets a lot steeper for major trading partners. I mean, just look at these numbers. You've got China, Vietnam, Taiwan. The effective rates are huge. And this is where it gets really serious. Because a policy like this doesn't just happen in a vacuum. It's expected to crank up global market volatility and, you guessed it, create new inflationary pressures. We're talking about a shock to the whole system, with ripple effects that could challenge global supply chains and even increase the risk of recession. So that brings us to a really tricky problem for investors. If the markets are this chaotic, where do you go? Where do you hide your money? The complication is that the traditional safe havens, well, they might not be so safe anymore.
Okay, to really get why, we need to quickly break down two key terms. And this comes from some great research by Alliance. First, you have a safe asset. Think of this as something defined by its structure, like U.S. Treasuries or German bonds. They're built to be stable. Then you have a safe haven. This is all about behavior. It's an asset that's supposed to hold its value or even go up when everything else is crashing. And here's the kicker. A safe asset isn't always a safe haven.
And this table, wow, this really illustrates the problem perfectly. If you look at the major geopolitical shocks we've seen, like in 2022 and 2026, almost every single traditional safe haven failed. Gold, nope. The Japanese yen, the Swiss franc, not safe havens. Even U.S. Treasuries didn't act as a haven. The only thing that really held up, the one place investors could run to, was the U.S. dollar. That's pretty telling.
So if the old playbook is out the window, what are you supposed to do? Right? Well, that brings us to the solution. Let's get into a practical survival guide for traders with a 5-step strategy for how to navigate all this volatility. Okay, so based on what veteran traders are saying, here are 5 absolutely essential steps. Number 1, shrink your position size. Just make smaller bets to limit your losses if things go wild. 2, diversify. Spread that risk out across different assets, sectors, even different currencies. 3, use stop losses. This is non-negotiable. It's how you protect your capital. 4, keep cash ready. Think of it as your opportunity fund for when you see those sharp dips. And finally, number 5, don't get emotional. You have to cut your losses quickly and just adapt to whatever the market is telling you. And that really leads perfectly into this next quote. In turbulent markets, hope is not a strategy, discipline is. I mean, this is the most important takeaway, right? It's not about hoping for the best. It's about having a disciplined plan for risk management. That's paramount right now. All right, for our last section, let's zoom way out. Because all this volatility we've been talking about, it's not happening in isolation. It's part of a much bigger structural shift that's already underway in the global financial system.
What we're seeing is that central banks around the world are fundamentally changing how they allocate their reserves. They are diversifying away from the US dollar and just piling into gold, buying over 1,000 tons for the third year in a row. It's a massive move, and it's a clear signal they are reducing their dependence on the dollar.
And get this, by mid-2025, something happened that we haven't seen since 1996. The value of gold held by central banks actually surpassed their U.S. Treasury holdings. Think about that. This is a monumental shift. It's a sign that even the world's biggest financial institutions are preparing for a totally new, multipolar economic reality.
So, that leaves us with one final question, and it's really a personal one for every single investor watching. In a market that's being driven by tweets and tariffs, you have to ask yourself, is my strategy built for the past? Or is it ready for the future?